Hey, good morning, options traders, and happy Friday, everyone. Well, I thought it would be fun to round out the week with a little bit of a more of a fun video, but also hopefully informative, that I'm going to call Can You Find the Edge? And this came about when I was speaking to another trader about a recent hyped up boxing match last week, Floyd Mayweather and Logan Paul, and looking at the money lines. And if you ask most traders about this, they will not be able to tell you what the edge is against them. And yet it's a fairly simple type of a numbering system. And so what my point is that if traders can't figure that out, imagine how difficult it is when you're in the multidimensional world of options. So just try to follow along. And my point again is that if you're finding this difficult, imagine the difficulties that you really have to face when you are trading options. So on Sunday, June 6, 2021, was the fight between Mayweather versus Paul. And at least in the US, this is a common way of listing betting odds. So for Floyd Mayweather, there's a minus sign in front of this number. It's minus 800. And these numbers are always per $100 bet. So what this means is that you have to spend 800, that's money going out, in order to win 100. Now, if you look at Logan Paul, it has a plus sign. That means that's $500 coming in, assuming you bet 100. Now, of course, most places don't require that you actually bet these amounts, but they must be in these proportions. That's the way the payoffs would be. So what happens, a lot of times traders will look at these and go, man, why would I want to spend 800 to make 100? That's just a bad deal. Well, they're not realizing that Mayweather is a crowd favorite, and that's why the price is high and the payoff is relatively low, just like it is in the options market. For Logan Paul, it looks like a good deal to spend 100 and perhaps make 500, but that's because he's a big underdog. And so yes, the price is bid down, very cheap, and the payoffs are very big rewards. But the thing that I wanted to show here is what is the edge against you? And there's always an edge against you, whether you're in the betting world or in the casinos or in options, even if for no other reason, for commissions. And you've got to be able to figure out what these odds are against you. So how can we look at these numbers and figure out the house percent, or what's sometimes called the take? Well, for the first bet, spending 800 to win 100. And then the second bet was spending 100 to maybe win 500. So the reason that they have to do these as two different bets is, think about it. If you walked up to a friend and said, I will bet you 800 to your 100, what's your friend betting on? He's betting on 100 to win 800. He's just taking the opposite side of the bet. But they're not doing that here. They're saying if you bet 100, you're going to win 500, not 800. So if this is a perceived fairly valued bet, you're getting shortchanged big time. And it doesn't really matter. We don't know which one is relatively high or low. We just know that there's a discrepancy. So this is one way to at least see that there is an edge against you. So how big is this edge? Well, let's again start with the first one, spending 800 to win 100. Mathematically, if you are spending 800 to win 100 and it's a fairly valued game, the implied probability is this number divided by the total. It's just 8 to 1 odds in your favor. So the implied probability is 800 over 900, or about 89%. So sometimes you'll hear this called the break-even percentage. And what this means is that if you were allowed to take this bet thousands and thousands of times, statistically, that because you've got this 89% edge, that if you're always paying 800 to win 100, you would just be expected to break even. Now, of course, in the real world, you're only going to get one shot. But that's what is being implied, that there is an 89% chance for Mayweather to win. Now, what about for Paul? Well, there you can spend 100 to win 500. So what are the implied probabilities? Well, it would be 100 divided by the total of 600, or 16%. So now take a look at the percentages. There's an 89% chance for something to happen here, a 16% chance down here, and if you remember from basic statistics, this should add up to 100%. And it doesn't. It adds up to 105%. So this is one way to show that there is roughly a 5% edge against you. I say roughly because I've rounded these numbers. but that's one way of seeing the edge against you. What's another way? Well, if you can buy Mayweather for an implied probability of 89%, the house is selling Mayweather for an implied probability of 89%. They're just on the opposite side of the bet. But this is where it gets tricky. If the house is selling Mayweather at 89%, mathematically, they are also buying Paul at 11%. That's just what's called the complement. 89% plus what makes 100% would be 11%. They are mathematically buying Paul at 11%. But what was the percentage at which they were willing to sell Paul? That was spending 100 to win 500, or 16%. So notice that they are buying Paul at 11 and selling at 16, and there is your 5% edge against you. So again, I just wanted to make this fun and to show you that there is always an edge against you somewhere, and if you don't know where it is, you probably shouldn't be placing the trade. And it's only going to be that much more complicated with options. So remember, when you are trading options, it is not about what you think the underlying stock will do that matters. The market doesn't care what you think. What matters are the implied probabilities. And do you have an edge in your favor, or do you have an edge against you? And that's really what you need to do to succeed. So for anybody who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.